I've spent a lifetime studying the great minds of investing, observing their triumphs and their missteps, and among them, Benjamin Graham stands apart. He was not a man chasing headlines or seeking glory in the markets. He sought one thing above all, to understand how to protect and grow capital with intelligence and discipline. Today, we live in a world obsessed with speed. News flashes, instant alerts, and market chatter bombard even the most seasoned investors. Yet Graham's wisdom, forged during the turbulent years of the early 20th century, offers a calmer, more measured path. He taught that wealth built recklessly is often wealth lost, and that protecting your hard-earned money should come before chasing enormous returns. In this video, we will explore the defensive investor's four-step checklist, a framework Graham designed to help everyday investors safeguard their capital while achieving modest, reliable growth. This is not a guide for the thrill seeker or the speculator. It is a roadmap for the patient, the disciplined, and the rational. As we go through these steps, I will share stories from Graham's lifetime, the crashes, the recoveries, and the investors who thrived because they followed reason rather than impulse. I'll also connect these lessons to today's markets, showing how his advice remains profoundly relevant nearly a century later. And while each step may seem simple at first glance, I promise you, the simplicity hides a powerful truth. The path to financial security is often less about clever moves and more about steady, consistent action. But before we dive into the first step of the checklist, let's take a moment to understand who the defensive investor really is, for knowing yourself is the foundation of every wise investment decision. When Graham wrote about the defensive investor, he wasn't describing a timid or uninspired individual. He was describing someone committed to protecting their capital, avoiding mistakes, and maintaining a steady course through the ups and downs of the market. Unlike the enterprising investor, who spends hours analyzing companies, hunting for bargains, and attempting to outsmart the market, the defensive investor's goal is simpler, yet no less important. Safeguard what you have while earning a reasonable return. Think of it this way. The defensive investor is like a seasoned sailor navigating a stormy sea. They do not chase the fastest ship or the most daring route. They choose a sturdy vessel, check their sails, and plot a course that will carry them safely to port. Similarly, Graham's defensive investor focuses on reliable investments, sound principles, and disciplined habits. Even in Graham's time, during the Roaring '20s and the devastating crash of 1929, the contrast was clear. Many investors were swept up in speculation, buying shares because prices were rising, not because the companies themselves were solid. They suffered tremendous losses when the market turned. The defensive investor, by contrast, waited, measured risk, and relied on proven fundamentals, often weathering storms that destroyed the fortunes of the reckless. In today's world, the defensive investor is not a relic of history. They're the person who invests in high-quality, well-established companies, balanced bond portfolios, or broad market index funds, avoiding the temptations of get-rich-quick schemes or fleeting trends. They understand that wealth is not created overnight, but preserved and grown steadily over time. And with this mindset as our foundation, we can move to the first step of Graham's defensive checklist: diversification, the art of not putting all your eggs in one basket. Graham's first principle for the defensive investor is deceptively simple. Never concentrate your investments in a single stock or bond. He called it a matter of common sense, but one that many investors ignore even today. Imagine, in the 1920s, an investor who placed their entire fortune into a single, booming company, convinced it would continue to rise forever. When the market crashed in 1929, fortunes evaporated overnight. Graham observed that such behavior wasn't the result of bad luck. It was the result of overconfidence and a failure to respect uncertainty.
Graham often illustrated this with a bridge analogy. If you estimate a bridge can hold 10,000 pounds, you wouldn't drive a truck weighing exactly 10,000 pounds across it. You'd use a much lighter load, allowing for errors in judgment or unforeseen weaknesses. Similarly, investing with a margin of safety ensures that mistakes, market swings, or unexpected events do not destroy your capital. In the 1930s, Graham applied this principle to distressed stocks and bonds, buying when prices were well below the net current assets or earnings potential of a company. Many contemporaries thought it was overly cautious, even boring, but it was this discipline that allowed Graham and his students, including Warren Buffett, to build enduring wealth. Today, the principle remains the same. Whether you analyze individual stocks, mutual funds, or even real estate, never overpay. Always consider the intrinsic value and ensure your purchase price provides a cushion against uncertainty. This is the safeguard that turns patience and discipline into long-term success. With these 4 steps, diversification, high-quality stocks, bonds, and a margin of safety, a defensive investor is equipped to navigate markets with confidence. But Graham also offered wisdom beyond the checklist, guiding investors on how to manage their emotions and expectations, which we'll explore next. Graham knew that even the most carefully constructed portfolio could fail if the investor lacked emotional discipline. He observed that the greatest danger in investing is not market risk, but the behavior of the investor themselves. Fear and greed, overconfidence and panic often lead to poor decisions. He introduced the concept of Mr. Market to illustrate this point. Mr. Market is a fictional character who shows up every day offering to buy or sell shares at wildly fluctuating prices, often based on moods rather than facts. Some days he is euphoric, offering absurdly high prices. Other days he is despondent, selling for pennies on the dollar. Graham advised investors to treat Mr. Market as a partner, not a guide, taking advantage of opportunities when prices are favorable, but never being swayed by his emotions. For the defensive investor, this meant resisting the urge to chase market fads or panic during downturns. Even during the Great Depression, those who held on to quality investments and avoided emotional reactions emerged with their capital intact and ready to benefit from the eventual recovery. In modern markets, the lesson is just as relevant. Headlines, social media hype, and short-term volatility can tempt even seasoned investors to act impulsively. Graham's advice? Stay calm, focus on intrinsic value, and let patience work for you. With emotional discipline established, the defensive investor can now focus on the final component of Graham's guidance: periodic review and portfolio maintenance. Even a perfectly constructed defensive portfolio requires regular attention and adjustment. Graham emphasized that the defensive investor should not buy and forget entirely, but neither should they obsess over daily price movements. Instead, periodic reviews ensure that the portfolio continues to meet the investor's objectives and adheres to the principles of safety and quality. Graham recommended reviewing asset allocation at least once a year, rebalancing between stocks and bonds to maintain the desired risk profile. If a particular stock's value has risen significantly, it may now represent too large a portion of the portfolio, requiring partial sale. Conversely, underperforming sectors or bonds approaching maturity may need replacement with more suitable options. He also stressed checking the fundamentals of the investments themselves. A company that was once high quality may experience deterioration in earnings, debt levels, or competitive position. The defensive investor must remain vigilant, selling when the original rationale for the investment no longer holds. By combining periodic review with the previous 4 steps of diversification, high-quality stocks, bonds, and a margin of safety, the defensive investor builds a resilient portfolio that can endure market turbulence and compound wealth steadily over decades.
Diversification is your hedge against the unknown. Graham recommended a broad mix of high-grade bonds and high-quality stocks, with no single investment dominating your portfolio. He suggested that for a typical defensive investor, a 50-50 split between bonds and stocks could be adjusted slightly depending on market conditions, but the key was balance. The lesson is timeless. In today's markets, diversification can mean spreading your investments across different sectors, geographies, or asset classes, so that no single downturn destroys your progress. Graham believed that a well-diversified portfolio reduces risk without sacrificing reasonable returns, and it allows the investor to sleep at night, confident that their wealth is protected. But diversification is only the beginning. Even the most balanced portfolio requires discipline and quality. This brings us to the second step of Graham's defensive checklist: choosing the right stocks, the pillars of stability. Once your portfolio is diversified, Graham emphasized the importance of investing in companies with strong fundamentals, businesses that can endure market fluctuations and economic storms. For the defensive investor, it was never about chasing the hottest stock or betting on fads. It was about quality, consistency, and reliability. Graham suggested focusing on companies with a long record of profitability, stable earnings, and strong financial health. During the Great Depression, many companies that appeared promising in the Roaring '20s failed miserably when the economy turned. Those that survived and eventually thrived shared common traits: conservative management, prudent debt levels, and products or services in consistent demand. He also warned against the allure of popular stocks, those hyped by speculation rather than substance. Many investors, captivated by rising prices, ignored the underlying health of the business, only to see their wealth vanish in a sudden market correction. The defensive investor, in contrast, evaluates intrinsic value, not market hype, and chooses companies that provide a margin of safety. In modern terms, this might mean investing in well-established blue-chip companies or index funds composed of such firms. It's not glamorous, it's not exciting, but it works. As Graham often reminded his students, the essence of investment management is the management of risks, not the management of returns. With high-quality companies selected, the defensive investor moves to the third step of the checklist: bonds and fixed income investments, the foundation of capital preservation. Graham insisted that a defensive investor's portfolio should include a significant portion of high-grade bonds. While stocks offer growth, bonds provide stability, predictable income, and a cushion against market volatility. In Graham's era, government and high-quality corporate bonds were the preferred choice, offering safety while still contributing to overall returns. He advised that a defensive investor should maintain a balance between bonds and stocks, adjusting slightly depending on market conditions, but never abandoning safety for the lure of speculative gains. The idea was simple: bonds are the bedrock upon which a secure portfolio is built. They protect capital during downturns, provide income, and give the investor the confidence to hold on through turbulent markets. During the stock market crash of 1929, those who had diversified into quality bonds fared significantly better than those who invested solely in equities. Bonds did not make them rich, but they prevented financial ruin. Today, the same principle applies. Whether in government treasuries, investment-grade corporate bonds, or bond ETFs, fixed income assets act as a stabilizing force in a defensive portfolio. Yet bonds alone are not enough. Even the most cautious investor must monitor valuation and price. This brings us to Graham's fourth and final step: investing with a margin of safety, the ultimate protection for your wealth. The final step in Graham's defensive checklist is what he called the margin of safety, perhaps his most famous principle. In simple terms, it means buying investments at a price significantly below their intrinsic value,
so that even if the future is uncertain, the risk of permanent loss is minimized.
But there's one more insight Graham offered, often overlooked: the importance of temperament and realistic expectations. Graham repeatedly warned that success in investing is more about temperament than intelligence. A defensive investor does not need to predict the next boom or uncover hidden opportunities. Instead, they must be patient, disciplined, and rational, willing to accept modest but consistent returns rather than chasing spectacular gains. He cautioned against comparing oneself to speculative investors or the latest market trend. The defensive investor's goal is capital preservation and steady growth, not excitement or heroics. Graham wrote that many investors lose money not because they lack skill, but because they let emotions override reason, buying high in optimism and selling low in fear. Setting realistic expectations is critical. Graham suggested that a defensive investor should be content with average market returns, understanding that attempting to outperform consistently often leads to mistakes. He likened investing to gardening. One plants seeds, tends them carefully, and waits patiently for growth, rather than trying to force immediate results. This mindset, combined with the 4-step checklist and disciplined review, forms the foundation of Graham's defensive investing philosophy. It is a strategy designed to protect wealth, minimize risk, and allow patience to turn time into compounding power. Finally, we come to the conclusion, the timeless takeaway that ties all of Graham's guidance together for the modern investor. Looking back on Benjamin Graham's teachings, one thing becomes clear. His philosophy was never about getting rich quickly. It was about safeguarding capital, thinking independently, and investing with patience and discipline. The defensive investor's path is steady, unglamorous, but remarkably effective over time. By following the 4-step checklist, diversification, high-quality stocks, bonds, and margin of safety, and by cultivating emotional discipline, periodic review, and realistic expectations, an investor can navigate even the most turbulent markets. From the 1929 crash to the Great Depression, Graham's principles proved resilient, and today they continue to guide investors facing the unpredictable swings of modern financial markets. His lessons remind us that investing is not a game of luck or speculation, but a careful application of reason and patience. Treat Mr. Market as your helper, not your master. Buy investments below intrinsic value, balance your portfolio, and maintain discipline above all else. As you step away from this story, remember that the essence of Graham's wisdom is simple. Protect your capital first, invest intelligently, and let time and patience work their magic. In a world obsessed with fast gains and instant results, this approach may feel old-fashioned, but its enduring power has been proven across generations. And perhaps the greatest insight of all, true wealth is not built overnight, but over decades, with thoughtfulness, restraint, and respect for the rules of sound investing. This, in essence, is the defensive investor's path, the Graham way to financial security and peace of mind.